Good morning all, and welcome to our latest webinar on auto-enrolment and the changes to the standard fund threshold following the Finance Act of 2024. My name is Brian Sexton and I head the consultancy team here at Unio Employee Benefits. If you wish to submit questions, the question box is on the left of the screen and we will try to answer a number of these questions at the end. This morning, we will provide the latest overview on auto-enrolment. We'll also recap on the AE process and key features of the auto-enrolment system. We'll then cover some of the announcements that have occurred in the Finance Act and the employer considerations that are required in advance of the AE launch date. We'll also then look at the recent announcement in the Finance Act on the standard fund threshold, and we will then try to answer a number of questions at the end of the session. So, in terms of the latest overview, well, we had a session earlier in July, and since then we've had a number of announcements. So, the Minister for Social Protection, Heather Humphreys, has signed the commencement order, which will now see the first enrolments under the auto-enrolment scheme begin on the 30th of September 2025. Earlier in the summer, it was proposed that the AE system would begin at the 1st of January 2025, but that date has now moved back to the 30th of September. In terms of employees may opt out after the mandatory 6-month period. However, after 2 years, the employee may be re-enrolled. The Minister has also secured the approval for the establishment of the National Automatic Enrolment Retirement Savings Authority, or NERSA, and that will be set up effective from 31st of March 2025. The board and the executive management of NERSA will then have 6 months in advance to oversee implementation for the launch date of 30 September 2025. We now have a name for what the AE system will be called, and that is My Future Fund. We also have received confirmation of the administration provider, and that has been Tata Consultancy Services, who will provide the administration services to NERSA. Interestingly, Tata Consultancy Services currently provide the administration services to the Nest system in the UK, so they do have experience on the auto-enrolment front. So just to recap in terms of who is going to be auto-enrolled into My Future Fund. Well, it will be those individuals aged between 23 and 60, earning between 20,000 and 80,000, not already in an occupational pension plan. This will include employees on probation, casual, seasonal, or fixed-term contracts. There will also be a voluntary opt-in for employees outside of those age and income thresholds. So essentially, if I'm 21 and I wish that the employer puts me into the auto-enrolment system, then I do have the ability to opt into the system rather than be automatically enrolled. Those currently that will be excluded are the self-employed, those non-earning, and those existing members of occupational pension plans and PRSAs. The other important thing is currently there is no equivalency test for the pension plan as to not have to participate in the auto-enrolment system. To recap on the contribution structure then, in years 1 to 3, the employee will be required to put in 1.5%. The employer will match that, and the state will put in 0.0 0.5%, making a total of 3.5%. In years 4 to 6, that will increase to 3, 3, and 1 by the state, making a total contribution of 7. Years 7 to 9, it'll be 4.5, 4.5, 1.5 from the state, making a total of 10.5%. And then after 10 plus, it will be 6, 6, and 2, making a total contribution of 14%. The contributions payable are on employees' total gross earnings, which are capped at 80,000, and the contributions in the AE system are deducted from net pay. So I suppose just how the system will operate for employers. Well, as we've confirmed, the go live date is targeted to take place on the 30th of September 2025. NERSA will coordinate assessing employee eligibility and notifying employers. So essentially what will happen is NERSA will check employee data to see if there are currently pension contributions being made. Then NERSA can see that contributions are being paid to a pension plan, in which case the employee will not be automatically enrolled in the AE system. NERSA checks the amount of the employee's pay during the relevant pay reference period. For example, an employee has exceeded 5k in gross earnings in a 13-week period prior to the start date of the new regime, they will deem to be in scope, and the employee will be automatically enrolled in the central system. And NERSA will issue an AE payroll notification to the employer / payroll provider. The body will also notify the contribution rate which will be deducted from the employee's pay, and as we are aware, that will be in years 1 to 3, 1.5% of gross earnings. And then I suppose employers must ensure they have communicated the auto-enrolment to the impacted employees and must ensure that the relevant contributions are made through payroll. And an AE return must be made through payroll to NERSA, in addition to existing revenue PAYE returns on or before the payment date to employee. So I suppose that just gives you an overview in terms of practically how the system will operate if you are in an auto-enrolment structure. So we recently just had the Finance Act passed, and what has that confirmed to us? Well, it's confirmed that there won't be any tax relief on employee contributions. So unlike current pension schemes where an employee gets tax relief on their contributions, there is no tax relief on contributions to the AE structure. The company will pay the contribution and the government will give essentially a payment in lieu of giving tax relief. So as regards some of the other components, they are as we currently have for existing pensions. So employers will receive tax relief on their contributions. Growth in AE funds are exempt from tax. Retirees will be taxable on any annuities payable from AE funds, and there will be a 25% lump sum available through the AE structure, and these will be applied on the same basis as current pension lump sums. Therefore, an individual can take up to 200,000 tax-free from an AE structure as they currently can from existing pension arrangements. So I suppose really in terms then of some of the design principles, we'll look at what a current pension plan and how it would actually shape up against auto-enrolment. So I think the key thing here is that really the pension scheme offers a lot more flexibility than the AE system will offer. to employers and employees. So in terms of the eligibility conditions for joining a pension plan, they're based on the scheme rules. The auto-enrolment, as we've defined, is quite specified as regards who are required to opt in to the system, and the contribution rates, as you will see under the pension plan, are flexible. The employer can determine the amount that they wish to put into the occupational pension scheme, and also AVCs are permitted to be paid into the pension scheme. Under the auto-enrolment system, there's not flexibility there, so essentially the employee can only put the specified contribution that the auto-enrolment system requires. So that would be 1.5% in years 1 to 3, and similarly the employer is capped with the amount that they can put in based on the tiered contribution rates that we looked at earlier. In terms of tax relief, we referred to that earlier. So currently under a pension plan, tax relief is given based on the standard or marginal rate, either 20 or 40% as applies to the individual. Under the AA system, contributions are paid from gross earnings, and as we've said, the state will make a subsidy of 33% of the employee contribution paid, so a third on top, as we've outlined. Retirement ages under the occupational plan, normal retirement age is between the age of 60 and 70. Members can retire early once they've reached the age of 50, and in serious ill health, members can retire before that age. With regard to auto-enrolment, it's in line with the state retirement age, which is currently 66. So essentially it is tied in to a fixed retirement date there. So the option of early retirement under AA is not available. Fund choices, there's a wide range of fund choices that you can have under your pension scheme. With the auto-enrolment system, they're going to be limited to 3 investment profiles. Interestingly, at this point, there has been no providers appointed to provide the investment services to the AE system, or My Future Fund as it's called. The other item, just in terms of leaving employment, so when an employee leaves less than 2 years, the employer is refunded back to the employer, and the employee is entitled to a refund of the value of their contributions. However, under the AA system, any contributions employer and employee paid into the auto-enrolment scheme are retained by the scheme for the employee. The other final point I suppose we'll make is that under a pension scheme, there is advice from qualified professionals in relation to individuals drawing their benefits, company advice and support, whereas under the auto-enrolment system appears to be a no advice type structure, which will be an electronic service by default, essentially. So I suppose really then from a company perspective, you know, I suppose we've outlined, we do know that the go live date now is the 30th of September. A decision will be required by the company to actively participate in this AE system, or amend your current pension plan rules to make it AE compliant and use this as your sole vehicle. Or the other option is to use a mix of both. I think probably what we're finding in terms of conversations that we've had with employers during the course of this year is that many are inclined to adapt their own pension scheme in order to have that as their sole vehicle, rather than have essentially a mix of auto-enrolment and their existing pension plan. But I suppose that is an area that each employer will have to consider on an individual basis as to what works best for themselves. So as we've kind of outlined here, some of the options a company may wish to consider is, you know, with your current pension plan, make it possibly compulsory rather than voluntary, using the current contribution structure. This may have issues around legacy employment contracts, so that would need to be looked at. For those that don't currently have a pension plan, that there's no scheme currently in place, then you could go about designing a structure and setting up a pension plan and not participate in the AE system. And then the other option is that you would introduce a minimum employer-only contribution, which we would recommend basically 2% of basic earnings for any of your non-pension plan employees, and encourage employees contributions using any currently matching structure that you have in place. This would avoid the need to participate in the AE system. And the reason for this employer-only contribution rate is that essentially you're not, we believe, interfering with employee contracts. This probably would just need to be looked at on an employer by employer basis, but a notification would need to be advised to relevant employees affected by this. Or the other thing is just leave your existing plan unchanged, and anybody who's currently not in the pension plan will be auto-enrolled under the AE system. So a number of considerations there for employers. So as I suppose we've outlined, you look at the gap, decide the best route, your plan for your existing, future-proof for new staff, and basically implement. As we said, it will need careful planning. I think we're probably fortunate that the date has been moved back to give us all some time to basically put in place appropriate structures. And if that is adapting the existing pension scheme, then we really think that that can be achieved in advance of the 30th of September go live date for AE. We do believe it really is important to start planning early in 2025. So I suppose we're happy to talk to each of our clients and work through the solution that will suit them best. So next, moving on to the standard fund threshold and some of the changes that was introduced as a result of the Finance Act 2024. So I suppose just to advise, the standard fund threshold is the maximum tax efficient amount that you can have in your pension fund, and the limit currently in place is 2 million for that. Minister Michael McGrath set up a working group to examine the standard fund threshold and the current limits and the operation of that earlier in 2024 when he was Minister for Finance. And that group basically reported just in the late summer of this year, and they made a number of suggested changes to the standard fund threshold. The Minister for Finance subsequently changed from Michael McGrath to Jack Chambers, and in the Finance Act, in the budget, implementing those changes, we were advised of how the standard fund threshold would be operated moving forward. And what was agreed was that in 2025 the standard fund threshold would remain at 2 million. In 2026 that would increase to 2.2 million. In 2027 it would go to 2.4, 2028 2.8 million, and from 2029 onwards it would be 2.8 million plus an indexation factor published by the Central Statistics Office. So obviously that means some changes for people in terms of their funding, and probably for a number of senior executives that may have been close to the 2 million cap and have looked at maybe reducing pension contributions or ceasing pension contributions. The increase in the limits will now possibly look to initiate further discussions around future pension funding into the scheme. In terms of the working group that was set up, they had suggested some changes to the rate of chargeable excess tax, which is charged when somebody is over the standard fund threshold. The Minister has announced that they will remain unchanged, and they anticipate having a specific review to take place by 2030 on that. So I suppose we'll have to wait and see in relation if there is a change to that chargeable excess tax that's currently in place. There was some speculation and some recommendation that that would drop to maybe a rate around 10%. The threshold for higher rate tax to apply to lump sums will remain at 500k, so the maximum lump sum will be linked to the current 2 million threshold. Provisions that allow an individual to offset tax paid on lump sums at the standard rate tax against CET liabilities is also to remain unchanged. So this is where if you do go over the standard fund threshold, you can offset the tax paid on your lump sum between 200,000 and 500,000 against that CET liability. Indexation will apply on pension fund benefits taken in prior years. So what we're going to look at is an example of that, and that there is no change to the multiplier factors. So this was another recommendation in the working group's report, that the factors applied to effectively make your defined benefit pension fund into a cash equivalent be reduced, and we'll kind of touch on that in one of the later slides here. So I suppose just in terms of an individual who's drawn pension benefits in 2025 and what their limit will be moving forward. So if an individual draws 800,000 worth of fund in 2025, they will have an available threshold of 1.2 million in that 2025 year. However, if they subsequently take benefits from a scheme in later years, the amount that they took in 2025 will be increased upwards, and we can see how they will apply. So if you were to take your subsequent further benefits in 2027, the value of the benefit of 800,000 you took in 2025 will be uprated or indexed to 960,000, meaning that you will have an available threshold remaining of 1440 rather than 1600 or 1.6 million. And we can see there how that applies in the future years going forward. So the value of the SFT and the prior benefits increase at the same proportional rate. Finally, I suppose in terms of the multiplying factors, so the working group had recommended that the multiplying factors be revised. And we can see here the existing multiplier factors for benefits accrued post January 2014. So an individual that is age 60 and say has a defined benefit pension benefit of €10,000, to get that to a cash equivalent, you'd multiply that 10,000 by 30, giving a 300,000 equivalent lump sum amount. The working group had recommended that that reduced to 21 for a 60-year-old, so that would then have become 210,000, which obviously then gives further scope regarding the standard fund threshold and the value of those DB benefits that would apply to both public and private sector pensions. So I suppose we'll have to kind of wait and see whether in subsequent legislation that those changes will be implemented. I think the Minister said that there will be further work looked at in terms of the standard fund threshold around CET, as we mentioned earlier, and I'd say no doubt they will probably look at the multiplying factors. But as things stand at the moment, there was no change to the existing levels of those. So that concludes the presentation this morning. So we'll just probably reflect and maybe just look at a couple of questions that we've received during the course of the session this morning. So I'll just take them in order here. So I suppose one is if an employee wishes to put more than the 1.5% into the AE system, does the employer have to match that amount? So no is the answer there. Under the AE system, the employee cannot put more than the 1.5%. They can only apply the set rates that apply. So there is no flexibility for the employee to put any more, much the same as from the employer perspective, to put any more than the set rates that are specified in the actual legislation. Another one that's come in here, just in terms of if we introduce a 2% employer-only contribution rate, can we simply maintain that without having to pay the subsequent higher rates into AE? So really, I suppose the answer to that is not forever, because there will be an equivalence test that will be being outlined to take up to 7 years to be implemented. So potentially, if the equivalent test is not outlined until year 7, then you can maintain that 2% up to that point where the equivalency test is outlined. At that point, when the equivalency test is outlined, it's likely you will have to adjust your employer contribution to probably match the AE contribution rates. But I suppose really we have to wait and find out what the legislation does say around that. But as things stand at the moment, if the legislation isn't announced for 7 years, then you could run a 2% rate for that 7-year period. I suppose the other thing is the reason why would we say 2% as opposed to 1.5% is that the 2% is essentially on basic salary, whereas the 1.5% is basic plus overtime plus bonuses. So I suppose the 2% just basically keeps you, probably just around equivalent to 1.5% of overall earnings there. So that's where the 2% is derived from. Okay, we just probably time for one more question here before we wrap up. In terms of the SFT, when does the benefit crystallization occur and what rate applies? So the benefit crystallization event occurs in the year you draw down the benefits. So if in 2027 and you've not drawn down any previously pension benefits, you will be able to withdraw up to 2.4 million in that year and be under the standard fund threshold as it applies. I see we do have a number of other questions that have come in, and what we will do is we'll look at those and we will subsequently try to reply to those questions subsequently to individuals through their consultant. So I hope you found this morning's presentation of interest. I'd like to thank you for joining the webinar this morning and wish you well for the rest of the day and for the weekend. Okay, thank you.